An important tool in budgeting is being able to reconstruct accounts. What accounts we're talking about our ledgers accounts from the general ledger. So the purpose of account reconstruction is to calculate an important value that we otherwise don't know. So we've got 3 steps. First, identify. So we have to think about every transaction that could be in the ledger account we're being asked to reconstruct. So will there be bank entries? Will there be stock control entries? Will there be cost of sales entries? Anything and everything that could be in that account. Step 2 is to match. So from what we identified in step 1, we need to find that information, those values from the question. This could be in a written form, or we might have to look through budgeted financial statements to find the information. Or it could be in additional information afterwards, so we need to make sure we look very hard. There are 4 crucial bits of information we need. We need at least 3 of them, with the 4th one being what we're finding out. Third step is to complete. So what we're doing here is we're reconstructing the account. We have our ledger account, we put the information into it, and we use the reverse process of balancing the account or closing the account to discover our missing amount. So our example here, 1st of January, our stock control balance is $10,000. At the end of December, so a whole 12 months later, our stock control balance is $23,500. We had a stock gain of $300, drawings of stock was $1,000, and cost of sales total was $54,000. So we'll start off putting our balances in. Our opening balance, as at the first, was $10,000. So that I color-coded here, $10,000 in red, $10,000 in red. On the debit side, because stock control is an asset. Same way, let's put our closing balance in. We know our closing balance is going to be on the debit side at the bottom for $23,500. From our reverse process, we know that balance also has to be on this side for our calculation to hold true. So we can put closing balance on the credit side for the same amount. So that's the only entry we put in twice. Our next item is the stock gain of $300. Stock gain means that we have, after a physical stock take, more stock on hand than we thought, than was in our books. So therefore that's going to increase our stock control. So we're going to put the $300 stock gain in green on the debit side. Next item is drawings of stock. Drawings of stock is when the owner takes the stock home for personal use. Decreases the owner's equity figure, so therefore it's going to decrease our stock control. So in purple, the drawings of stock has come out on the credit side. Cost of sales, we know, is how we expense the stock when we sell it. So in orange, we put that there as a credit. It's going to reduce the stock control balance because we've sold it. Finally, our figures in yellow. Now there's 2. Before we said there was 3 bits of information, which were opening balance, closing balance, and the cost of sales. Means we need to find out the stock we purchased. We've got how much it started, we've got how much it closed with, how much went out, so we need to work out how much came in. The additional information here said stock is purchased with 75% on credit and 25% on cash. That means we need to differentiate. So, what we worked out is that by adding up the complete sides, which in this case would be our credit side, we went 1,000 plus 54,000 plus 23,500 gave us 78,500. We put that to the debit side. We then took away the $10,000 of opening balance and $300 of stock gain, which left us with 68,200. We then times that amount by 0.75 or 75% to get our credit sales amount, and then we times that 68,200 by 25% or 0.25 to get our cash sales. Our cash sales we've cross-referenced as bank, and our credit sales as Creditors Control. So even though we needed to work out one amount of the stock that came in, because of that rule and additional information, we had to split it to the 75% credit and the 25% on cash.